Okay, we're all set, Jim.
Very good. As Vice Chairman of the county, Franklin County LDC, I would like to call this meeting to order and remind everyone that we have just a single item to consider, so there will be no need for us to adjust the agenda. The agenda is as is, and for that, I guess the rest of it, I'll turn it back to Jeremy.
So the single agenda item today is to review the Fcldc annual report and audit. And we've got Pam and Michael again today. We appreciate them coming back for a second performance here. And then the only actual agenda item is to consider accepting the LDC audit. So Pam, take it away.
Great, and thank you for accommodating us and allowing us to do this report today. So much the same that we covered the other day. We start out with the independent auditor's report. Gives a report on the financial statements, management's responsibility for the financials, and that's for the presentation and the preparation and fair presentation. The auditor's responsibilities. And the standards that we use auditing standards generally accepted in the US and standards applicable to financial audits contained in government auditing standards. We let you know if we've obtained reasonable assurance about whether the financial statements are free from material misstatement. We perform procedures to obtain enough evidence about the amounts and disclosures in the financial statements, and then we let you know that we believe the audit evidence is sufficient and appropriate to provide a basis for our opinion. So we do give an unmodified opinion, and this is based on the audit entries that we propose will be adjusted, and that way the financial statements are fairly presented. We do give a report on summarized comparative information. So unlike the IDA and the CDC, this is a not-for-profit, and these fall under different standards, but we do show the comparative information on last year's audit. So it also doesn't have that management's discussion and analysis section because that is not required. There's a other matters section, which we have a schedule of the economic development zone revenue and expenses. So we let you know what we've done in relation to that. And we also have the Yellow Book report, and that's on our consideration of internal controls over financial reporting and compliance with grants, laws, contracts, and regulations. So then we get into, on page 3, the statement of financial position. So this is what we look like at December 31st, 2020 against 2019. Our total assets are $3,549,000. That's up $22,000 from last year. Last year they were $3,526,750. Our cash and equivalents are up $2,424. Our grants and contracts receivable are $332,000, and that's up $138,000 over last year. So in there we have our tourism contract, our grants, and last year I believe that was primarily micro enterprise. So we had about $170,000 of loans of reimbursed expenses that we recognized last year. Prepaid expenses are $6,683, very close to what they were last year. They're down about $555. Our loans current are up $22,000, and our long-term loans are up $23,000. So overall, our loan receivable is $45,000, up $45,000. We have also restricted cash of $2,393,000, and that's down about $110,000 from last year. We did increase the allowance this year, another $42,000, and that's primarily because the makeup of the loans has changed. So every year we're looking at that. You as management are assessing an allowance that's appropriate, and it's very comparable in percentage to the prior year. Then we get into our liabilities section, and our total liabilities are $46,299. So those are down from last year's $69,000 by about $23,000. Our accounts payable and accrued expenses were up overall $34,000. A lot of that has to do with timing. Credit cards are in there as well as payables, and any of your compensated absences would be in there. So we did add more employees during the year, so that balance did go up. Then we have a section, deferred revenue. This is unearned revenue that you have received and are not expended. So in the past, we've recognized those with the ASAP PAC loan that was funded with HUD funds. Each year we would recognize that piece of that. That loan was paid off during the year, so we have no deferred revenue at the end of the year on that. And then we also had the Empire Zone funds. So we would recognize the unearned revenue equal to the expenses each year, and the revenue would get recognized. But since that program is done and you actually ended up transferring those funds after year end over to the IDA for operations or to promote economic development, then we recognize that whole thing this year. So there is no more unearned revenue on your books. Any questions on the statement of financial position? So we go on to the statement of activities. Our total revenues, so we have some revenues without donor restrictions, and then we have some with donor restrictions. So in total, there's $733,000, and that is up from last year's $521,000 by $212,000. Our local government funding was up $30,000, and that's primarily recognizing that portion that we had in the Empire Zone funds. So we recognize that whole piece that was in deferred. It also includes the tourism and economic development services, your grants, like your technical assistance, the New York State Housing and Community Renewal amounts, the Main Street and the Saranac Lake Energized Downtown, which are really cool names. And our fee income is our fees that are from the Carey Center. So those were very equal to what we had last year, down about $300. Our loan interest income is $53,679, and that's up just very 1,000 over 2019, very, very close. Our interest income was $13,000. That was down from last year. We had $41,000. So that was about a $28,000 decrease. And last year we had some CDs. Those both had matured. You rolled it over, and then in the year they matured. So we didn't have any CDs at the end of the year. Our program income is the deferred revenue recognized for that loan portion of the ASAP PAC loan that was funded with the HUD funds. Other income includes your PPP money, so your Paycheck Protection Program money, about $23,000. So it starts out as a loan, but you met the requirements and have applied for forgiveness. So you are able to record that as revenue. There also, on the purchase of the mortgage that you did in the restructure, there ended up being about a $42,000 gain on that. So that is also in that amount. Then we get into the section about our total expenses. So there's $688,000, and that's up about $267,000 over last year. Last year was $421,000. And then on the next page, we break that out functionally. So I'll just go over some highlights there. Our salaries and wages were up $114,000, but we did hire two more employees during the year. Fringe was up about $18,000. With the salaries increasing, we would also expect the fringe going up. Our consultant services were $114,000, and those were up $96,000 over last year. Marketing was up $36,000. Our legal fees were up $13,000. Our office expenses were up $15,000. And we had last year grants paid to others. This was down overall $66,000. And of course, we have grants to the IDA that we picked up on the IDA side. Our bad debt expense was up 38,000. So when we adjust that allowance, it goes to the bad debt expense. So that did increase. The allowance had been stable for a few years. And then last year we had a loan that was actually written off for 3593, which was that one that had been hanging out there. So that is it for the statement of functional expenses. Do we have any questions?
Yeah, just one question, Pam.
Sure.
The bad debt expense, would you explain that again?
Okay, well, when you have your loan balance, your loan receivable, we're evaluating the loans out there and you come up with an allowance. So it's offsetting that receivable amount. And if anything's written off, it's written off against the allowance, and then you adjust the allowance. So, okay, good. Thank you.
Thank you.
Thank you. It's a good question, and I could answer it. So that's always good. Then we go on to our statement of cash flows. So we don't spend a lot of time on this. We did have a net decrease of cash of 107,000, pardon me. Last year's decrease was 244,000. So that just shows what was in and out, totally cash basis. Then we get into our notes. Our notes are on pages 7 through 17. We go through what the organization is, talk about the revolving loan fund. We give you what those definitions are of net assets. So net assets without donor restrictions and net assets with donor restrictions. Grants and contracts. We give you what's cash and equivalents. So that cash flow statement would tie to the unrestricted cash as well as the restricted cash. So it gives you a nice reconciliation there. Then we get into the streams of revenue. So we did add some more verbiage there on the different programs because you have a lot more going on this year. So we give you that. And then we talk about compensated absences. So since we have more employees, the compensated absence liability at the end of the year was about 8,800. The year before it was 5,000. So, and the allowance is actually 30% of the total loan. Last year was 27. So note that. Note 2 is fairly new. This note lets the reader know what the financial assets that are available for general expenditure within the year. So we lay that out there. Note 4 is our restricted cash and cash equivalents. So last year we had a CD at the end of the year, and then we had our cash. We did have a notes loans advance. So we talk a little bit about your small business relief program and the loans that were made during that. And I believe one loan was actually paid off during the year in full. Then we get into note 6, which goes a couple pages, excuse me, that lays out what the loans were at the end of the year. So, and the balances compared to the prior year. That goes on through page 13. So we have 1,080,000. Last year we had 1,035,000. Note 7 breaks out what our capital assets are and accumulated depreciation. So our net capital assets are almost 11,000. Last year they were almost 7,000. Note 8 gives the net assets that have donor restrictions. So we did restate amounts that previously had been recognized as having donor restrictions, and that involved the revolving loan fund. So it has been clarified that those should actually be not donor restricted because it's in the revolving loan fund. Any grant coming in until the conditions are met for that grant to be recognized, those would be considered donor restricted. So we do have some tourism money that was receivable at the end of the year, and those haven't met the criteria to be unrestricted, but they do meet the criteria to be recognized. And then we have our satisfaction of program restrictions, and so that 26,000 was that last ASAP PACT payment. Note 9, we let you know what amount has been restated. Note 10 gets into our commitments and contingencies. And then we also added the Paycheck Protection Program, what you received, and you are eligible for forgiveness, and you believe that the forgiveness has been met, and it has. So you're just waiting for the official word on that. Note 11 talks about our unearned revenue, which I covered. Note 12, we'd like to disclose what the concentration of the loan portfolio is. So we do have one obligator with outstanding loans of 26.8%. And then we have another one of 22%. Note 13 gets into the related party transactions. So I believe we have that note across all three entities. The economic development merger agreement. So that was agreed to in November of 2018. You're in your second year of that. Well, now you're in your third year if you're talking about 21. The tourism promotion services. So that was suspended for the COVID time and then was reinstated. And you also have an extended agreement 1 year, right, with more extensions available. And then we talk about the functional expenses. So those are expenses are allocated on a reasonable basis and applied consistently. Note 17 is on tax uncertainties. Because you're a not-for-profit, you do file a tax return. We are working on that. And we let you know that the IRS could potentially look at tax years, including 2017 and later. Note 18, standard reclassification note. And we did reclassify things in the prior year to be comparable to the current year. Subsequent, yes, I'm sorry.
Page 16, note 17, tax years including 2017 and later.
Yes.
Is that the normal look back, or is that
yes,
we did?
It's 3 years. So it's 3 years we look at, including that year. So we haven't filed the 20 yet. So right. We're looking at 17, 18, and 19. And next year it will move up. Yeah, it rolls forward a year every year.
Okay, good.
And then we have subsequent event notes. So we looked at between the end of the year and March 15th, which is the date of the report for possible disclosure and recognition in the financial statements. We give the standard COVID note. And then we also added that you have applied for forgiveness, again, under the Paycheck Protection Program, and you're expecting that to happen. So then we get into the Yellow Book report. And that, again, we're looking at our internal controls over financial reporting. So we're looking at our errors or potential misstatements captured in the normal course of employees performing their normal duties. So we do look at what's happened with our journal entries that we have to propose, and we kind of look at those individually and in the aggregate. And if they get to be what would be a material level, then we need to actually note that to you, let you know. And we did have some adjustments in there that were at the material dollar amount. Most of that had to do with your new revenue streams. So we're getting the expense side of things okay, but it's the revenue that we're not recording. So when you're expending any grant funds or any funds that you're going to get reimbursed for, we should actually be recording a receivable on the revenue at that time. So we suggest, coming up with spreadsheets per program and tracking that, and then on a monthly basis, going in and adjusting those amounts so that you always have a true picture of what you look like during the year. So that is it for this report. Are there any questions?
Going back to note 12 on page 15. Give me a second here. I gotta wheel this. I noticed that the organization's portfolio shows the largest obligor is 26.8 and 22.4. Do you have a number a percentage number that is safe? In other words, where do you think, based on your accounting standards, what's the number? Is there a number percentage-wise?
I would say it would be on the lower end of things, what, 10 or 15% maybe of the,
Yeah.
what would you say?
Yeah, I would say 10% is probably a decent number, that it isn't a concentration. So all you're saying when something's a concentration is that the loan portfolio has a lot of, in this one debtor has a lot of their assets. So it's 26% of the entire loan portfolio. It's just letting a reader know, well, there's a potential that if that debtor didn't pay the loan, the agency would take a hit for a fairly large hit of their loan portfolio. Doesn't mean it's not going, it's going to happen. It's just telling readers and you, the board, that there's a concentration in a few debtors to the agency that you need not so much to be concerned about, but that it's there, that concentration is there.
So if I'm reading this,
And the other, with respect to that, is do you compare that against our report of our payment? We only have one. Actually, we only have one person that's unsatisfactory at this point in terms of their commitment.
Right, and that's what we look at to assess the allowance. So in this one, it's just straight numbers. So this loan balance is part of this much of the whole portfolio.
And the other one is an assessment that management does in terms of coming up with an allowance for bad debt that conceivably doesn't have anything really to do with whether a loan is bad or not, because you really don't know what's going to happen down the line on somebody who's performing very nicely, making payments all the time, but you don't know what's going to happen. So the allowance percentage is more geared of a kind of a weighted average of a number of years of where you've been on bad debt write-offs. So they're two different calculations. One is just letting a reader know, and you as the board to know that there is a concentration in a few debtors in your portfolio. The other is an allowance for doubtful accounts that may not even have there might not be anything for these debtors right here.
Right, and both of these have been paying, so that is not an issue.
so it's a matter of exposure to risk, basically, through an obligation to a single
Very
debtor.
well put.
Right.
That is exactly what it is.
Following up on Jim's point, can you just talk about the second sentence in that note compared to the first? If I'm reading this right, in 2019 we had one obligor with 36% of the portfolio, and then by the next year, basically that risk somewhat softened because we had one with 26.8. So we somewhat made things better.
Less of a concentration. So just based on the balance at the end of the year of the loan to the total portfolio.
Okay.
That's what those were. So, and of course they've been paying, so it would go down. Well, both sides would go down, but then you had new loans.
Portfolio increase, so percentages were changing.
As we make lending decisions in the future, to be prudent, I mean, just as a guideline, we should try to minimize our exposure to any one obligor.
Absolutely, yes.
Keep that below the 20s certainly anyway, if we could do it, right? That's the following up on Jim's point. Is that?
It's prudent, so, but that is completely a board decision. So if there's mitigating factors that make taking that risk a little bit higher, a little bit more favorable, It's certainly up to you. All we're doing here is just giving those percentages.
When the state looks at these, if they said, let's take a look at your books and we want to see your audits and all, and this follows up on Jim's point also, is there a point at which we would expect their hackles to be raised somewhat? Or would it be 30, 40, 50% or something like this? If we went big with a single obligor that was really apart from what our past practice had been, would that really raise concerns? Is that?
I can't speak to exactly what they're looking at, but I know in the past, back in 2014-15, you did have much higher of a concentration in one obligator. So it was much higher.
Okay, well, that's
I
helpful.
could actually get those numbers for you because we keep them every year, but
yeah, that's all right. It's just it's and I appreciate that. It's helpful because I don't know, I'm in my second term, I guess. I'm still somewhat of a newbie. I'm excited to go back to 2015, so I appreciate hearing that.
you know, your activity and your I'm sorry, go ahead, Jeremy.
I'm gonna make a programming note. We have Justice Martin on now, and we also have somebody 483-6681. Don't know who that is.
That's
but...
me.
Archie.
Oh, Archie. Okay, welcome, Archie. So we have Archie now and Justice.
Good.
And just to follow up, no, I believe Madeline has to leave for a meeting, so I'm just mentioning that.
I think I'm okay. I had changed my meeting to later in the day.
Oh, great.
Overall, Pam and your organization, overall, what kind of a health rating would you give us? Excellent? Good?
Well, you know, there's stuff auditors are not allowed to say, but you do have a positive balance. So we would look at our net asset.
Yeah.
We had an increase.
Well, your financial statements are fairly presented. So we would be able to say that easily. And you're doing what your purpose is.
Yeah.
So your purpose is to, as far as the revolving loan goes, to make loans to organizations that may not be credit worthy in terms of some of the banking institutions. That's how you get, micro enterprises, smaller entities to get money to start up and move forward. So that's the whole purpose of the loan program. And as
Sure.
Pam said, you've taken on a lot of other things,
Right.
certainly in 2020, the tourism money, the bed tax money, and obviously you added employees for that. So you're kind of getting off the ground there. And that's where one of our larger adjustments came from, is handling the recognition of the revenue on that. So there's some new growing pains that are starting as you take on more programs. That causes a little bit more risk to the organization as people start to learn how to do that. And on the accounting end, the accounting department getting ready for that and knowing what they have to do to recognize that revenue. And as Pam pointed out, the best suggestion is to come up with an Excel spreadsheet, each tab representing a contract with an agency or a donor, and putting the terms down, and then keeping track of revenue and expenditures, so you can keep track of that. It's just a matter of coming up with systems that will work for your agency.
Thank you. That was very clear. Thanks a lot. I appreciate that.
Yeah.
All right.
I appreciate our boring down on this. This is really in all what we're doing. The LDC is really where the action has been, and it's good to get into the look at a little bit of get a little elevation on this, and looking at what's been happening, kind of taking this apart a bit. It's helpful.
Yeah.
Okay, good.
Your programs are very exciting. I enjoyed reading about them. I think I read every single resolution.
That's
So
good.
it's exciting and it's a lot of energy. So it's nice to see that. Although it was more work. A lot.
That's why
More work
a
on,
little later on this one. It took us a little
Right.
more work
longer.
on your end, yeah.
Normally when I get the loans tied up, I'm good to go, but it was like, oops. So poor Jeremy and Maria were dealing with me a lot back and forth. So
A lot
Well,
going on.
Michael said, talked about growing pains, and I think that's certainly, we've been living through it, and the things that were pointed out in the that last attachment are something that Maria and I need to double down on and present some changes to our controls and procedures and get some, and I feel that we need to get some assistance to make sure we're doing that right. And as was pointed out in your statement, Pam, Michael, there's only so much that you can do because of the legal obligation to keep a separation as an independent auditor. And I think that's I'm really glad that you pointed it out, because sometimes I think it's natural to just say, well, they know what they're doing. They know us and all that kind of stuff. So thank you for pointing that out, just to help us remember that there is that obligation to keep that separation or independence so that you can do the auditing correctly. And we need to keep, not that we haven't been trying, we gotta keep doubling down on making sure we're doing the accounting correctly for all these new opportunities and programs. So
We are
work
able
into-
to share with you. So Pam's a member of the Not-for-Profit Quality Institute of the AICPA. So she can go on to that and see if there's some work papers that they have that, and they have example not-for-profits. And so if we can find something there, we'll pass it
yeah, we're
along.
able to share that. We just can't ever put ourselves in the position of impairing our independence or auditing our own work. So that's definitely a no-no.
Right.
Got it.
Okay, good.
Great.
Very good.
Jeremy, Jim Ellis, I'll remove myself from the chair and let Justice pick up, because I think we're at a point that we have to discuss whether or not we're going to accept the audit.
Okay.
Okay, thanks, Jim.
Thanks, Jim.
You're
Sorry
welcome.
I got on here late.
No problem, Justice. We're all set. Thank you.
So the only action that needs to be considered today is whether to move forward in approving this audit. Is anyone prepared to make those motions?
Yes, Jim Ellis.
Okay.
Move to accept the audit.
Do we have a
Steve-
second?
Steve will second.
Okay. Any other discussion or questions? So why don't we go ahead with the roll call, Maria?
Pay to accept resolution 2021-13, accepting the fiscal year 2020 audit. Sherry Boye is absent. Michael Doran,
Yes.
James Ellis,
Yes.
Stephen Erman,
Yes.
Madeline Fleury,
Yes, I approve.
Justice Martin,
Yes, I approve.
Archie McKee.
Yes.
Okay, carried.
Great.
Very good. Well, we can,
Thanks again, Michael and Pam.
yes, thank you so much.
Thank you for
Thank
giving
you.
us this time. We really appreciate it.
And thank you, staff.
Yes.
Yes,
Yes,
the agency was very nice to us.
they always are.
They do great work. So
They do, even in the challenges of, the COVID, so.
they got all this. They got all these this activity going. So they there comes the responsibilities to provide a lot
True.
of.
Good
Yeah.
vision.
Right.
All
Good.
right, thank
All right,
you.
thanks so much. We'll
Bye-bye.
entertain a motion to adjourn.
So moved, Jim Ellis.
Do I have a second?
I'll second.
Okay. Okay, very good. Meeting is
Great.
adjourned.
Okay.
Thank you, everybody, for your commitment to this.
Of course, it's nice to see everybody.
Okay. Thanks, everybody.
You guys,
Okay,
thanks,
thank you.
everybody.
Yep.